Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
Welcome back to the Rock and Turner podcast. This is James Emanuel, and today we are carrying on with the theme of serial and programmatic acquirers. Last time we were discussing acquisition as a business and the incredible results that companies can achieve through making acquisition the underlying business model. Starting from today and in coming weeks, we're going to be focusing on a number of these acquirers, both programmatic acquirers and serial acquirers. If you're not familiar with that terminology, please listen to the last podcast because we delve into the differences between these two critical models. For reasons that I don't fully understand, Scandinavia is a hotbed for this kind of company. Most people are familiar with names like Lagercrantz, Atlas Copco, Lifco, AdTech, but today I'd like to focus on two lesser known names that perhaps you haven't heard of. Our journey today starts in Sweden to look at a programmatic acquirer called Teqnion. That's spelled Teqnion, and its ticker is TEQ on the Stockholm Nasdaq exchange. Teqnion is one of Sweden's newer programmatic acquirers, founded back in 2006 by Johan Steen and Jonas Hagqvist. From the outset, the company has embraced a philosophy of highly decentralized management, taking cues from other Swedish success stories like Lifco and AdTech. Steen is still with the company and serves as its CEO today, and he puts it quite simply: Teqnion doesn't just invest in companies, it invests in people. The mission, he says, is to give founders a safe harbour, a place where their life's work can be preserved and carried forward. If that rings a bell, it should. It's straight out of the Warren Buffett playbook. But there's an important caveat here. Quoting Buffett is easy, actually delivering on that philosophy is another challenge entirely. So has Teqnion managed to pull it off? Let's take a closer look. A big part of Teqnion's investment case comes down to leadership, and in this case that means co-founder and CEO Johan Steen. He's no ordinary chief executive. With a beard that could rival that of Mark Leonard and a hobby of running ultramarathons for fun, Steen is a character who thrives on pushing the limits, and is proven both in sport and in business that he has grit and endurance to keep going long after others would have given up. To give you an idea of his stamina, in July 2017, Steen ran more than 266 kilometres. That's over 165 miles in a single day. That effort earned him a silver medal at the World Championships in 24-hour running, and along the way he set new Swedish and Nordic records. Just for context, that's the equivalent of running more than 6 marathons back to back. So if you're looking for a CEO with staying power, this is certainly your man. That same endurance mindset shows up in his business philosophy. Steen believes true value comes from acquiring and nurturing small, high-quality companies with lasting fundamentals. He's fond of saying that Teqnion invests in people, not companies, and he emphasises qualities like commitment, attitude and willpower just as much as financial metrics. This people-first approach is deeply embedded in Teqnion's culture and underpins its decentralised model, where founders and management teams are left to run their business with minimal disruption. By doing so, Teqnion avoids messy integrations and keeps the expertise that made those businesses attractive in the first place. Steen describes his role as that of a business-building, risk-taking, win-win deal lover. It's a very hands-on entrepreneurial mindset and one that has been central to Teqnion's growth. He also acknowledges his own evolution, from the early stages where he was more a by-the-book operator to a flexible, opportunity-driven business builder today. Of course, leadership at Teqnion isn't a one-man show. Daniel Zhang, now Deputy CEO and CXO, deserves a special mention. He joined the company in 2021, initially heading M&A and serving as interim CFO. And he was so integral to the company that he was elevated to the number 2 role, Deputy CEO, just 3 years later. Zhang has been instrumental in raising capital, optimizing M&A strategy, and focusing on acquiring profitable companies that align with Teqnion's long-term culture and shareholder commitment. Zhang's background is impressive. He's had stints at McKinsey and Bain Consulting, senior strategy roles at Textilia, and he's authored a book called An Investment Thinking Toolbox. Encouragingly, he's a committed Buffett disciple. He manages his own investment portfolio, he's an avid reader, always anxious to learn from others, and he constantly pushes himself to improve. In Zhang, what we find is management with an investor's mindset. He backs his own ability with his own money, and in 2024 he bought 100,000 shares from Steen at just over 200 Swedish krona per share, which is nearly 50% above where the stock trades today. That move boosted his stake in the company to 108,000 shares, which compares with Steen's 861,000. But what's striking is Steen's reasoning for selling to Zhang. He wanted Zhang not just to feel like a partner in spirit, but also in ownership. And in his words, he said, "I have the best job in the world. I got even better since Daniel joined us. The fact that we're now doing things together, arguing about new ideas and accelerating our journey pushes both me and the company. It goes without saying that Daniel should not only feel that it is his company, but that he is also an owner and shares in the long-term success. Even though I've never sold before, it is not with sadness, but with hope for the future and joy that I'm now selling a part to our unique CXO, Daniel." I thought you might be interested to hear from Daniel Zhang himself. So, Daniel, give us a quick elevator pitch for Teqnion.
There has been quite a lot of popular, let's call it popular rhetoric regarding how companies should be run. It has been very popular to talk about decentralization, full ownership, flexibility, agility, etc. And I think for some companies, they're doing this really well and they really walk the talk. And I would say that Teqnion absolutely is one of those where these are not pretty words on the wall, but it's something that we truly value and do at an extreme almost. There are maybe 2 things that I think keeps us apart from the rest. One is the culture, where we really value and treasure entrepreneurship and true decentralization, and we have an uncompromisable focus on individuals. We are not at all interested in growing a big forest. We are kind of arborists that pick out and cultivate the greatest oak, the finest maple, the greatest pine, etc. And that focus on individuals also mean that we kind of know the name of all, say, 350 people in the organization. And we have a culture that make people feel included. And especially the new entrepreneurs that have been selling their companies, they tend to forget even that they have sold their companies and they keep working in the same way as before. But now they have more friends. Secondly, what we try to do at Teqnion is that we act with great discipline when it comes to capital allocation. We are really relentless on that. I think we also have the highest cash adjusted return on equity among all the serial acquirers. We do not compromise at all on what we pay and thereby the return on equity. So we have a valuation approach that basically stems out from a discounted cash flow, but with some adjustments. So very simplistically, we try to get back our money on a cash basis within 5 years. That's basically the valuation approach that we have had since the founding of Teqnion in 2006, and we've kept that until now, and will continue to forever. We want entrepreneurs to join us because they and we together believe that we are the best fit for their companies. And I mean, to be clear, we are absolutely not the best home for all kind of unlisted companies or for all personality types, but we want to find that match. And those that only want to get the highest amount of dollar amount for their company, I mean, I understand that perfectly, but that is not the kind of culture and individuals that would be a perfect fit with Teqnion. So nowadays, we actually only do our own approaching of companies, where we find and search for companies that we believe have a good future, and we call them and ask if they would like to be part of our Teqnion family. And sometimes they say yes. We are very disciplined when it comes to valuation. So obviously not all meetings lead to an actual deal. And we also approach these companies ourselves. So it's not like these entrepreneurs have been thinking too much about selling, and they sometimes are not ready, or I would say most of the times they are not ready to sell now. So some of the traveling we're doing now probably would bear fruit in the years to come, while sometimes it can be really quick, where everything and all the stars are aligned. It could maybe just take 3-4 weeks, but we are in no hurry because we focus so much on the individuals and culture. We do not use consultants. We try to keep lawyer firms away whenever possible. We try to sit down with the person so we can show each other where we stand and what we think about. And the focus is really on the qualitative aspects. Obviously, we do the due diligence on the financial side as well, but that is more as an insurance that everything is as we thought, and it's very secondary to the feeling we get from the individuals and the culture. When we walk around there in production, are people smiling? Do they feel that they belong to a group? Those are things that we really look for and treasure in our acquisitions. At Teqnion, for example, we have different financial goals, and I think the most important one is that we will try to double our earnings per share over a very long period, but we'll do it on average every 5 years or so, and which means that in 50 years or so we'll do 1,000-fold. So that's the risk I try to think about. And in acquiring companies, instead of thinking about fluctuations, there are some unlisted companies, private companies, as well as listed companies that have a lot of fluctuation in their financials from quarter to quarter or maybe year over year. And overall, fluctuation is something that is not loved by the investor community. People overall like a smooth journey. But because we are a serial acquirer, all of the companies that we acquire would become a very essential part, an important part of the whole group. But none of them would be big enough to be able to make or break the group. So risk, for example, here is very interesting. So I love companies that have certain fluctuation because other investors do not like to buy them. Prices overall are a bit lower. But as long as the risks, or actually the fluctuations here, are not correlated with the other companies that we have, it doesn't really matter for us if we have a number of companies that fluctuate quarter to quarter. It also only means that we get them at a lower price. And I also think that in a lot of cases, the fluctuations are more on an accounting side than on a fundamental side, which I think is quite important to also think about the difference there.
Thank you, Daniel. That's really helpful. In terms of succession planning, Zhang looks very much like the heir apparent, although it should be noted that Steen shows no signs of stepping down anytime soon. At age 52, he says he wants to keep doing this work for as long as he can contribute. And given his stamina with his ultramarathons, he could still be leading Teqnion decades from now. But whenever the baton is eventually passed, Zhang seems positioned to carry the torch to ensure continuity. Together, Steen and Zhang have shaped a philosophy that stands apart from the growth at all costs mentality of Silicon Valley. They avoid forecasts and annual targets that could force hasty deal-making. They don't chase growth for its own sake. They focus on businesses they understand, not grand predictions about the future. They prioritise safety over speed, resisting the temptation of high-risk bets. And above all, they think in decades, relying on the compounding power of careful capital allocation and seeing themselves as long-term stewards of shareholder value. Teqnion's growth story is at its core an acquisition story. The model is straightforward but powerful. Find profitable, niche-focused industrial businesses, acquire them, and hold them indefinitely. Over time, this builds a diversified family of companies that grow together through the steady compounding effect of disciplined capital allocation. Where Teqnion stands out is how it approaches acquisitions. Instead of forcing new subsidiaries into a rigid one-size-fits-all playbook, the company works with sellers to shape a tailored path forward. That flexibility and the trust it builds has become a genuine competitive edge. It makes Teqnion an attractive buyer for high-quality businesses whose founders want an exit but don't want to see their life's work dismantled by a more traditional private equity play. Teqnion, as a holding company, intentionally stays very lean. Its role is to provide strategic and financial support, not to interfere in day-to-day operations. This hands-off model is deliberate. It helps preserve the entrepreneurial drive and specialised expertise that made these businesses successful in the first place. And for many sellers, that's exactly what makes Teqnion such an appealing long-term home. At the heart of its model are three guiding pillars: stability, profitability, and shareholder value. Financial discipline is central. Net debt to EBITDA is kept under 2.5 times. EBITA margins are targeted above 9%, and the goal is to double earnings per share every 5 years. That last target translates into a compound annual growth rate of around 14.5%. And tellingly, for each of the past 5 years, Teqnion has managed to deliver on all 3 of these objectives. 5 seems to be Teqnion's magic number. The company not only aims to double earnings per share every 5 years, but it also structures acquisitions so that free cash flow from the acquired business covers the purchase price within the same time frame. In practice, that means buying companies at around 5 times EBITDA. With organic growth layered on top of the acquisitions, the math works out to support Teqnion's long-term compounding target. The focus, however, isn't just on price, it's also, of course, on quality. Teqnion looks for businesses with solid financial track records and products or services that will remain relevant for decades. The goal is to hold them forever, creating a compounding machine that reinvests cash flow into more acquisitions. The resulting portfolio is a broad and eclectic mix. Subsidiaries range from AirTarget, a defence technology business, to AaaB Nordia, which supplies laboratory equipment, to LFX, a maker of foldable electric wheelchairs, and even more striking, some acquisitions are as low-tech as UK lanyard makers, a business with no moat and no competitive advantage, but with the one thing Teqnion values most, dependable cash flows. Diversification acts as a risk shield, ensuring the group's performance isn't overly tied to any single market or economic cycle. That approach is especially evident in Teqnion's recent expansion into the UK. In May 2025, it acquired Norlin Polymers, marking its 7th UK deal in under 2 years. So, having originally focused on the Nordic region, the company has shown it can replicate its model abroad, opening up a much longer growth runway. Ultimately, the investment case rests on Teqnion's ability to keep finding and acquiring these kinds of businesses. Each successful deal adds to the revenue and profit base, creating a flywheel effect that drives earnings higher over time. So far so good. We have a programmatic acquirer that has a great track record over a couple of decades and very competent management. But here's where the story gets more complicated. Teqnion is starting to look like a jack of all trades and master of none. As we discussed back in the introductory podcast, serial acquirers typically roll up businesses within a single industry, consolidating market share and unlocking efficiencies through scale. Programmatic acquirers, on the other hand, take a different path. They buy businesses across multiple industries, keep them decentralized, and don't try to integrate them. Teqnion clearly falls into the second camp. That's not inherently a problem. Some of the world's best compounders operate this way. However, the difference is that most successful programmatic acquirers still carve out a specialization, even if they're industry agnostic. Take Constellation Software as an example. It dominates in vertical market software, and Judges Scientific zeroes in on scientific instruments. Danaher, on the other hand, has built an empire in life sciences and diagnostics, while Halma thrives in safety, health and environmental technologies. Each has its own focus, which gives them an edge. They develop deep expertise, maintain operational discipline and consistently deliver superior returns. Teqnion, by contrast, lacks the same clarity of focus. Its portfolio looks more like a patchwork of unrelated businesses than a carefully constructed platform. That absence of specialization could prove to be its Achilles heel. While most other successful programmatic acquirers seem to use a sniper rifle for their acquisitions, it appears that Teqnion uses more of a scattergun approach. This arguably leads to what Peter Lynch famously called diversification, when too much diversification into unrelated areas ends up misallocating capital and destroying value. So let's explore the numbers and see what they can tell us. Over the past 5 years, Teqnion has posted impressive growth. Revenues climbed from about 635 million Swedish krona to 1.6 billion, nearly 1.7 billion, while earnings rose from 45 million to 115 million. That translates to an average annual earnings growth rate of around 22.5%, a clear sign that the acquisition strategy has delivered. The company has also shown that it can grow both organically and through deals. Between 2021 and 2022, revenue surged 44%, with nearly half of that driven by organic growth. Returns on capital have remained high, averaging around 18.5% return on capital employed over 5 years, while free cash flow margins of 9.5% highlight Teqnion's credentials as a credible compounder. But the share price tells a very different story. After peaking at 274 Swedish crowns, In February 2024, the stock has since fallen by almost a half, and it currently trades around 142 in August 2025. That drop reflects both fundamental challenges and the broader valuation reset. The top line has continued to expand, largely on the back of acquisitions, but cash flow tells a more worrying story. Free cash flow margins have deteriorated sharply, undermining the very foundations of Teqnion's acquisition-driven model. Cash conversion has weakened significantly, raising legitimate concerns about how future acquisitions will be financed. So the question becomes, why is this happening? Part of the problem comes from housing-related subsidiaries like Grimstorps, Hem1 and KFAB, which account for about 8% of the portfolio. Rising interest rates in Sweden, from around 0% in 2022 to around 4% in 2024, pushed up mortgage costs, dampening housing demand and dragging down these businesses. So on the face of it, this looks like a cyclical macroeconomic issue. Yet the latest results paint a mixed picture. Net sales for the group as a whole rose a healthy 19%, yet organic growth slipped 3%, meaning acquisitions are carrying all the weight, while existing businesses are acting as a drag. On the Q4 2024 earnings call, management acknowledged that nearly a third of its subsidiaries underperformed during 2024 and spent much of the call discussing how to course correct. That omission ties back to the earlier reference to diversification and the danger of lacking specialist focus when making acquisitions. In response, Teqnion's central management has become more hands-on with some struggling subsidiaries, a notable shift from its usual decentralised model. Even if temporary, this deviation suggests that a few past acquisitions may not have been the right fit. To his credit, Steen hasn't sugarcoated the situation. In the Q2 2025 interim report, he admitted the turnaround is painfully slow and that the company hadn't been sharp enough in adjusting to global uncertainty. This candour is refreshing and should build confidence that management isn't in denial. But by framing most of the problems as external, kind of macro headwinds, interest rates, housing cycles, there's a risk of overlooking internal systemic issues in the acquisition process itself. Management has been clear that persistent underperformers won't be tolerated. If a subsidiary continues to drag without signs of recovery, it will either be downsized, divested, or even shut down to stop capital leakage. So far, none of these nuclear options have been deployed, but they remain on the table. All of this raises concerns over the planned acceleration of acquisitions over the next 12 to 18 months. With free cash flow under pressure, how will these be funded? More particularly, if there are systemic issues in the growth engine, is it wise for the management to put its foot down hard on the gas before resolving those problems? The combination of all of these factors play on investor psychology, with sentiment becoming negative. But bear in mind that the Swedish stock market as a whole experienced a significant decline in 2022. It was down 29%, driven primarily by rising interest rates and inflation, which likely carried over into a broader risk-off mood during 2023-2024. This may explain some of the sell-off in the Teqnion stock. However, the significant drop in the market capitalization of Teqnion from the 2023 peak suggests that the stock was likely overvalued. Strong 5-year top-line annualized growth of 46% may have fueled a degree of investor overexuberance, with valuations running well ahead of fundamentals. The correction we're seeing now looks more like a rebalancing of expectations as growth slows and challenges come into focus. That said, the story isn't all negative. Steen has highlighted significant room for improvement in areas like operational efficiency, purchasing, and sales within the existing subsidiaries. If management can execute on these improvements, it could reignite organic growth, and if that happens, it would serve as a powerful catalyst for the stock. So is Teqnion attractive at today's valuation? Right now, it's hard to give a definitive answer. The evidence is still building. What we can say is that Teqnion remains a compelling, though not risk-free, long-term opportunity built on the proven model of programmatic acquirers in Sweden. Its small size, broad portfolio, geographic reach, and focus on niche markets all point to meaningful growth potential. But to fully unlock that potential, the company still needs to sharpen its approach to acquisitions and operational execution. A key strength lies in its leadership. Johan Steen isn't just any CEO, he's personally and philosophically invested in Teqnion's success. His relentless drive, paired with a financial commitment that ties his fate to the company's, gives Teqnion a unique and difficult to replicate advantage. If his ultramarathon achievements are anything to go by, he certainly has the grit and determination to overcome any challenge, and he has shown himself to be a winner. For outside shareholders, that's a rare asset. Recent results have shown some softness, slower organic growth and operational bumps, but at least some of this is due to tough macro conditions and the inevitable growing pains of a rapidly expanding organisation. Any structural flaws are not insurmountable, and importantly, management has been transparent about these issues, which should give investors some confidence. For those willing to stomach short-term volatility, the long-term picture looks promising. If organic growth can re-accelerate alongside a steady pipeline of acquisitions, Teqnion has all the ingredients to become a powerful compounding machine. It becomes a question of tuning out the quarterly noise and focusing on the durability of its long-term underlying business model. Otherwise, if this company is not for you, let's move on to the next company we're focusing on today, which is the Relais Group in Finland. It's not your typical industry company. At first glance, it looks like a small Nordic distributor and workshop consolidator. But digging a little deeper, what you find is this is a budding compounder in the vehicle aftermarket sector, and it's proven to be remarkably resilient through economic ups and downs. In a market where demand never sleeps because vehicles always need to be serviced and repaired, the Relais Group has compounded EBITDA at 18% a year since 2020. But before we explore the remarkable success this company has enjoyed in the last few years, let's explore its history. Its roots can be traced back to its 1996 founding in Helsinki, Finland. But in 2010, it acquired Startax Electronics, a Finnish distributor of automotive spare parts and electrical equipment. And that single deal set the foundation for what would become the Relais Group that we know today. Over the next decade, the business expanded through a series of bolt-on acquisitions, adding companies like Teknion in Norway and AaaB in Sweden. These were not high-profile targets, but rather well-run niche businesses that anchored Relais in the Nordic aftermarket. By 2019, the Relais Group had enough scale and momentum to take the next step, a listing on Nasdaq First North in Helsinki. The acceleration in growth post-IPO is clear to see. And it's well worth noting that throughout this entire journey of acquisitions, the company has remained profitable, which is testament to the quality of the management team. The decision to go public was strategic. Management recognised that in order to sustain its acquisition-led growth model, the Relais Group would need access to capital markets and the visibility that comes with being a listed company. The IPO also aligned with its stated ambition of doubling sales within 5 years by combining above-market organic growth with 1 or 2 acquisitions a year. The public listing of the company gave the Relais Group the currency, both financial and reputational, to accelerate its consolidation in what was otherwise a very fragmented market. The company has certainly lived up to its ambitions. Net sales have compounded at roughly 24% a year between 2016 and 2024. And while much of this has come from acquisitions, the company has managed to deliver mid-single-digit organic growth on a fairly consistent basis. It seeks to improve every business that it acquires. And the Relais Group applies a proven playbook, especially in its workshop segment, where it's shown it can turn good operations into great ones by professionalising the management, optimising pricing, and sharing best practice across the group. Leadership has been central to this success, and the CEO, Arni Ekholm, respected for his pragmatic style and steady hand, took the helm in 2015, and for the past decade has overseen the transformation from a local Finnish distributor into a multi-country consolidator with nearly 30 subsidiaries spanning Finland, Sweden, Norway, Estonia, Belgium and the Netherlands. In fact, my only reservation about this business is that Ekholm has announced he will retire in March 2026, and the succession plan seems unclear. The looming leadership change introduces an element of uncertainty. Succession will matter, especially in a company where cultural continuity and disciplined execution are critical. That having been said, Ekholm isn't leaving the business entirely. He'll move into an advisory and non-executive board level role and has committed to continuing to support the business through the transition and perhaps beyond. He owns shares equal to roughly 4 times his base salary, so it's in his interest to ensure that his succession goes well. It's also reassuring to know that at board level, the chairman, Jesper Otterbeck, and major owner, Ari Salmivori, collectively control nearly half of all the shares, so this ensures a long-term mindset that's aligned with external shareholders. So let's explore the company's strategy. Broadly speaking, it can be split into 2 complementary areas. The first is a technical wholesale and products division, which represents about 2/3 of sales, and it acts like a niche acquirer, buying up distributors and product companies in the vehicle aftermarket. And this side of the business benefits from attractive gross margins and the ability to scale private label products like its Nordic parts development brand. The other part of the business is the commercial vehicle repair and maintenance division, roughly a third of sales, and it resembles a roll-up of service workshops. And while these are lower margin than the parts division, the products division, it provides recurring revenue and showcases Relais Group's operational improvement playbook. Together, the two segments give Relais a balance of stability and growth potential. The group currently employs about 1,600 people and is operational across 8 countries in Northern Europe, primarily Scandinavia. In fact, the Relais Group is now the biggest operator of independent commercial vehicle workshops in the Nordic region. Its market is very attractive for a variety of reasons. Vehicles are staying on the road for longer, increasing demand for replacement parts and repairs, and Europe's aftermarket remains highly fragmented, with thousands of small and medium-sized businesses ripe for consolidation, which is perfect for an acquirer like the Relais Group. Despite its rapid expansion, the company still only generates little over 50 million euros in EBITDA, small enough that a single bolt-on can move the needle, yet big enough to prove that its model works, and it has a huge runway ahead of it. Competitors such as Alliance Automotive, Swiss Automotive, and Parts Holding Europe dominate at scale. But Relais Group is small enough that it can grow meaningfully with mid-size and small-size deals without coming onto the radar of these big players. In terms of financials, the Relais Group has built a record of strong cash generation. EBITDA has converted to free cash flow roughly 77% in recent years, and net income to free cash flow at over 100%. Acquisitions are financed out of cash flows augmented with a prudent level of debt. And when analysing this company, it should be noted that acquisitions see the financing debt hit the balance sheet before the EBITDA materialises on the income statement. So recent large acquisitions have caused the debt ratio to spike for this particular reason. However, once the EBITDA from the acquisitions flows through in the numbers, the leverage ratios will come down again. At the moment, they're hovering around 3.5 times EBITDA, but this really is a product of the timing mismatch of debt and revenues. It's worth noting at this point that management has alluded to having considered some form of debt for equity swap, leaving room for further acquisitions without over-leveraging. I'm sure you'll have your own opinion on whether or not this is a good idea. For me, I have my reservations. Equity is by far the most expensive form of capital, and while I would always be happy to see the prudent use of debt for paying down equity capital, doing things the other way around, as is being suggested here, makes me feel less comfortable. Nonetheless, returning to the acquisition record of this company, it really has been outstanding. Return on net working capital has been consistently over 50%, although due to a couple of large acquisitions recently, which involved assuming the working capital requirements of the acquired companies before the returns of those companies filter through, that's dropped to 43% in the first half of 2025, but it is anticipated to revert back above 50% once the returns on new acquisitions are fully integrated into the numbers. Both return on capital employed and return on equity are around the 12-13% range, which is a little below the mid-teens or better that investors associate with top-tier compounders. But as already explained, the recent larger acquisitions have temporarily depressed returns. And as organic operating leverage kicks in, the returns are expected to stabilise in the mid-teens. Proving that trajectory will be critical for a re-rating of this company. In terms of valuation, with a market cap of just under 300 million euro, the Relais Group is capitalised on an earnings multiple in the mid-teens, and its enterprise value is only 10 times EBITDA. Its top line for 2024 was 323 million euros, so it trades at around 0.9 times its historic sales and a bigger discount on a forward-looking basis. For a growing company with gross margins nearing 50% and operating margins around 10%, that looks like good value. It promises steady value creation with the potential for meaningful multiple expansion if management proves it can drive returns higher, so it certainly looks attractive at these levels. Ultimately, I think it's fair to say that the Relais Group is at an interesting inflection point. It's graduated from its early roll-up stage to become a credible compounder in the making, with scale, a tested acquisition playbook, and a healthy pipeline of targets. The challenge now is less about growth, which is abundant, and more about quality, improving returns, aligning management incentives, and navigating the leadership succession challenge smoothly. If it can do all of these things, the Relais Group could deliver exceptional long-term shareholder value. For investors, it's all about backing a growing compounder at an early stage in a defensive and fragmented market. If I've managed to pique your interest in this company, it's listed on the Nasdaq First North market in Helsinki, and its ticker is Relais, RELAIS. There's a write-up for this company on the Rock & Turner Substack with some charts and graphics that may also be interesting for you to look at. But if this company is not for you for any reason, don't worry. In the next episode, we'll be back with an introduction to another compounder for you to consider for your portfolio.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.